All right, is it pulled up for everyone? Awesome. Okay, so my name is Ashlyn Talcott, and I was in charge of venture capital investors, funds, and holdings. So I had a really unique perspective coming into this presentation because I actually had no idea what venture capital was or any type of investment strategy like that. Really, the closest knowledge I had was Marty Bird from Ozark. I don't know if you guys have seen that show. He's actually an angel investor. So that's the only knowledge I had on this topic. So it's really interesting to research it. And so I kind of pulled together everything that I found most interesting and kind of helped me understand the topic most. Um, so yeah, we will see some similar information to what Reed had just shared with us, some crossovers, but I think as Rick said, the more that we hear it, the more it'll kind of stick with us. So yeah, so we'll just go right into it. So what is venture capital? In simple terms, venture capital is money that's provided by investors to startups that have really high potential, so specifically potential to reshape markets and grow at a very, very fast rate. So the venture funds or investments are managed by venture capitalists, also known as VC, and this is pretty much just a fancy word for professional investors. So these are long-term investments. Venture capital funds make equity investments in a company whose stock is essentially illiquid and worthless until a company matures 5 to 8 years down the road. So it's definitely kind of a long-haul investment strategy. I really like this diagram. It kind of shows the differences between an angel investor, venture capital, what I'm talking about, and then private equity, which we will hear from later from Hayden. So this kind of just shows the main difference in terms of risk versus reward. So as we see it, as it goes down the spectrum, venture capital has a higher risk, therefore higher reward opportunity than, say, an angel investor, but less so than a private equity. Oh, and I didn't clarify. Anyone feel free to jump in at any time with questions. I also want to keep this as an open discussion with everyone. Yeah, so from there, I wanted to talk about venture capital timing, which is super, super essential to the industry. So actually more than 80% of the money invested by venture capitalists goes into the adolescent phase of a company's lifestyle. And so I kind of brought up this diagram on the right here that you can see. Interestingly, in this period of accelerated growth in the adolescent phase, the financial predictions of both eventual winners, being companies that end up with really high success and good profit returns, and losers, which is essentially the startups that go under, they look very, very similar in terms of their financial predictions. So we can see that on the right here, we have, so this is your startup phase, your adolescent phase, and then your maturity and shakeout. And so here we have your industry as a whole. You kind of have an upward sloping winner, same thing, loser, same thing. And so I just thought that was really interesting, just how in tune venture capitalists have to be with the decisions they make. And they have to be super careful looking at these financial predictions just because it's so hard to see at this stage when they invest what actually is going to be a profitable company and ones that will have success. Next slide. Okay, perfect. Okay, so now I wanted to go into the actual stages of venture capital investments because each stage comes with different reasonings and levels of growth in the company. So the earliest stage is seed funding, which we kind of touched on for us, but I'm going to just reiterate. So the name is pretty self-explanatory. This is the seed that will hopefully grow the company. It's used to take a startup idea to the first steps. So in this stage, the funding typically goes towards product development, market research, that type of stuff. So then the next stage goes to Series A. So this is when a company has kind of established product and market fit and kind of has started to make some serious buzz and the customer base is growing pretty fast. So in this round, startups are now expected to have a plan for developing a business model and use the venture capital fund to hopefully increase revenue. So after that point, you move on to Series B. So this is when a company has started to make considerable revenue and is simply looking to expand operations. And then from there, you go to Series C and onwards. These stages kind of have similar processes, but this is likely when a company is going to be operating on a global scale, and it might be ready for a possible exit strategy, which I will kind of go into at a later time what that means. So then we go into, I kind of wanted to talk about venture capital stakeholders and the main players. So there's four main stakeholders. There are the entrepreneurs who need the funding. They have this idea, they're startup, and they're just kind of stuck without additional financial aid. We also have the private investors who want the high returns. These are the investors that they fund the actual venture capital funds, and they work with the venture capitalists. I'll kind of get into that later as well. You have your investment bankers who need companies to sell, and then you have your venture capitalists who make money for themselves by making a market for the other three. So investors in venture capital funds are typically large institutions such as pension funds, financial firms, insurance companies, university endowments and foundations, that type of stuff. And they're really just in it looking for their high investment returns. So I did add this graphic down here, so it kind of just shows the order that it goes. You have your entrepreneurs who receive money from corporations and government, receive money from venture capitalists, who get it from investment bankers, private investors, all that type of stuff. So it really is just kind of a circular motion, which makes the venture capital work.
Can I interrupt you, Ashley?
Oh, of course.
In this figure you have drawn in the corner there, where does angel investors fit in? Or does it fit in there?
So angel, from my understanding, angel investor is a complete different type of investment strategy. So typically a startup will choose either to do an angel or a venture capital fund. From my understanding, please jump in if I'm incorrect, but it kind of just depends on different criteria. So like I said, venture capitalists, I believe they can fund at higher amounts. So if a startup wants higher than maybe an angel investor can offer, then they'll go to a venture capitalist.
Okay.
Well, and I think one other way to look at it is as angel investors could come between the entrepreneurs and venture capitalists. Like kind of the last one talked about, it is often angel investing is a smaller scale, and sometimes for an angel investor, venture capitalism can be the angel investor's exit. Mm-hmm. So an angel investor is going to invest at the beginning of the company, where a venture capitalist tends to invest when it's a little more mature. So it's just kind of like an angel investor can be the bridge between getting a brand new idea to the point where venture capitalists now are interested in investing in the company.
So usually a company has, like a startup company has both angel and venture capital investors.
It's certainly possible.
Okay.
So Henriette, think about it like this. We want, and we tend to try to have these very clean definitions. And we want to categorize an angel investor and a venture capitalist and a private equity investor. But the fact of the matter is the lines are very blurred, okay? So when you guys watch Shark Tank, are they angel investors or are they venture capitalists? Well, sometimes the money's enough that they're venture capital, you might think, and sometimes it's small enough you'd say they're certainly angels. But I got to tell you, Cuban sees himself as a VC, and some of these guys see themselves as angels. The lines are really very blurred. We categorize them so we can talk about them, but in practicality, it's not nearly that clean cut.
So there's two types of, like in terms of when we say venture capital, it's like you can be a venture capitalist as an individual, like with your own investments, or you can like work for a venture capital company that kind of pools funds and invests them over a broader sense? Is that how it kind of works?
Ashlyn, do you have an answer to that, or would you like me to?
Yeah, I have an answer. Yeah, that's exactly how it works. Yeah, you could do both. Really, venture capitalist, like I said, is just a fancy word for a professional investor. So that is where you'll see like the intertwining with angels. I think one of the distinctions as well, which Jaden brought up, that was a really awesome point, is it does kind of depend on what stage. So in a startup, typically angels will invest more towards the beginning. And then as I kind of mentioned, during the adolescent phase, that is more where venture capitalists will get involved. But yeah, it is, they do cross over. It's not a clean line, but from my knowledge, venture capitalists can either be, yeah, it comes in different types of forms, such as a firm or an individual. Rick, did you want to add anything to that?
Well, just that more often than not, we see that angel investors are investing their own money.
Mm-hmm.
Venture capital investors are typically investing some of their own money and some of investor monies that they've put together in a fund or a pool. And then as we move beyond that, it's into private equity. It's typically other people's money that's being invested. Those aren't hard, fast rules, but that's kind of typically what you'll see.
Again,
I also had a,
yeah, you can continue.
oh, sorry. I just had a quick question about, like, so when an angel investor or venture capitalist invests into a company, like, you know, X amount of dollars, right? But it hasn't hit the company hasn't hit an IPO yet, or maybe like never will. How do they quantify like what their investment is worth? Because like, let's say I invest $100,000 1 year, but the company still hasn't hit like the IPO. You know, how do you know like what your investment is worth if there's no like, you know, share price, like that kind of thing?
Well, Skylar, I think you might have a good answer to that.
Yeah, so short answer, there's techniques, DCS, there's just a bunch of different ways that you can model out what a company is based on their free cash flows, called free cash flow models. You need a lot with small businesses that have an IPO just so you know exactly what you have, like a market value based on multiples even. So you kind of get different metrics to use just based off cash flows and multiples from previous companies that have sold. As far as knowing what it's worth, you can never be exactly knowing what your investment's worth. The main point for venture capital firms is to hopefully bring that company to an IPO or through merger and acquisition, have it be bought by someone bigger.
And so, Dylan, those people that you saw on the screen that had big smiles on their face for a moment as you asked that question are all people that have had Finance 309 and maybe even 409 and have participated in valuation work. So there's a whole discipline that's devoted to this.
Cool. Awesome. Thank you, Skylar. Thank you for all the interjections. I love the questions. If that's all, I will keep going, but feel free to interject at any time. So then I kind of wanted to go into what venture capitalists expect out of these investments and their profit expectations. So essentially, investors in venture capital funds expect a return of between 25 and 35% per year over the lifetime of the investment. And again, this lifetime can be 5 to 8 years, sometimes even 10. And so in return for financing 1 to 2 years of a company startup, venture capitalists expect a 10 times full return of capital over 5 years. So they're definitely in it for the large profit margins. And then from there, the venture capital fund and its LP investors split the capital gains per a pre-agreed formula. So I did a little research on this. So typically the investors, this is what I talked about, are the foundations, university endowments, those types of things. Those investors expect 70 to 80% of the gains, where the venture capitalists will keep the remaining 20 to 30%.
Yeah, really quick question, Ashlyn.
Yeah.
So we're saying return 25 or 35. Is that on average? Is that on the first year they're expecting how much?
Sorry, can you repeat that? It was a little
Are they
clear.
expecting are you expecting them to make like 25 to 35% every year on the first year? Is that on average over the entire lifetime? Like they're not making so much the first year and they're making a ton at the end.
I believe that's per year.
Usually
Because
they're
then,
on the first year investment.
Yeah, so Damien, you're not going to see or even be able to measure it probably within the first year or two. So that's going to be an annualized value that they've realized over a period of years. So think of that as an average over a period of years. You only see this when we actually sell the asset, right? That's when you find out what your return was.
Mm. As how I understand it, is it like so if you can get return that quickly, the entrepreneur probably doesn't need those investment in the first place. The reason they need investors to put out these big investment and they'll trade stock or a share for it is because it's a relatively long-term investment and risky one. That's why, is it?
yeah, and just the more funding and stuff that you can get, especially during the adolescent phase and high growth, the more you can put into market research, you can expand your infrastructure. So the more money you put in at that time, it'll just help you grow the company even faster and hit those high profit margins. Does that answer your question?
Yeah, totally. So I think that confirm my mute button.
Awesome. All right, so then I did just want to discuss a little bit the advantages and disadvantages of venture capital because really it's important to address the pros and cons because it isn't the right option for every entrepreneur. You have other options such as the angel, the private equity, or just simply trying to reach out to friends and family. So some of the advantages are if your startup does go under, which is not unlikely, which I'll kind of go into the statistics there, but you're not on the hook for the money because unlike a loan, there's no obligation to pay it back. So that's a huge benefit for the entrepreneurs. Venture capitalists come to the table with extensive business knowledge, industry knowledge, and institutional knowledge, as well as networking opportunities. So typically venture capitalists will only invest in industries and companies that they're really familiar with. So they can bring a lot to the table to the entrepreneur to just pretty much advise them and give them guidance along the way. A lot of venture capitalists actually sit on the board of directors of these companies. And so they work with the original entrepreneurs to make good financial decisions for the company and guide the company in the right direction. And then additionally, simply large financial investments can help the business scale big and fast. Like I kind of mentioned, working with the infrastructure and increasing all that type of stuff. And then you have the opposite side. So while you don't technically have to pay back venture capital firms are expecting a return on their investment. So that means that the startup should be preparing for an exit strategy, which I'll go into on the next slide. But if that's not the goal, then venture capital is probably not the best option. If you're an entrepreneur and you're looking to stay with your company for more than 5 to 10 years, if you're in it for the long haul, then you probably shouldn't be working with a venture capitalist if you're not willing to let it IPO or let it be bought out, because you will have to give up part ownership of your company and power in the startup. All right, so then we have the exit environment. So as briefly touched on, a venture capital firm will get involved with a startup with the plan of an exit strategy in the future. And this is simply in order to obtain the investment profits. So the exit environment truly drives the measure of success. So there are various exit options for venture capital to cash out their investment. You have IPO, initial public offering, which is simply the strategy that makes the company public on the stock market. You have promoter buyback, mergers and acquisitions, and then sale to another investor. So pretty much you can IPO the company or it can be bought out. And these types of exits in the company simply allow the venture firm to distribute the proceeds to investors. From there, they can raise a new fund for future investment, and then they can invest in the next generation of companies. So as long as the VCs are able to exit the company and industry before it tops out, they can typically get back extraordinary returns at relatively low risk if they time it right. All right, and then something I found really interesting when I was researching is simply, where do venture capital firms invest? What kind of industries do they see the most promising results? So as I kind of touched on, venture capital firms will typically invest in companies and industries that they're already familiar with. They like to use their expertise and their already based knowledge. However, there are more desirable industries compared to others that have good growth potential. So for example, VC is excited in really any type of business that leverages information. So this can be artificial intelligence and machine learning, that type of stuff. And then we're currently seeing that venture capital funding is most widespread in fast-growing technology and biotechnology fields, which we can predict. So I added this table on here that I thought was pretty interesting. It shows us which industries brought in the most venture capital in the United States for the 2019 year. So we have $14 billion worth in commercial services, consumer goods and recreation. We have energy, IT hardware, media, pharma and biotech, all that type of stuff. So I just thought it was kind of interesting to see which industries really prosper the most and what venture capitalists look for when they're investing. So then I wanted to go on not only industry, but I wanted to kind of narrow it down. So simply, what type of entrepreneur do venture capital firms like to invest in? So in general, venture capitalists typically go for entrepreneurs who are simply willing to take the risks, have the ability to sell themselves and have a good pitch, and then are just proven and successful. Venture capitalists also take into consideration the individual's current positions, skills, reputation, and incentives to the firm, what they can bring to the table. And then as for teams, venture capitalists tend to look at two different types of skills, hard and soft. So in terms of hard skills, they would typically like to invest in teams with impressive logistics and business skills to run that side of the company. And then as far as soft skills, they would like to look into teams that simply work well together. They have little to none conflict. They share compatible values and have a strong support system. So those are kind of pretty broad personality traits of the people that they like to invest in. But I found this video that I'm going to play. It's only a couple minutes, but we get to hear from Brian Garrett. He's co-founder of Crosscut Ventures, and I just thought he gave really good insight to specific traits that come across attractive to venture firms from his perspective in that area. So I'm going to play that real quick.
I think there are four primary ways to make yourself attractive to a venture capital firm. And if you look at their task, they're trying to deploy capital in the best deals, and they need help figuring out which deals are the best deals, and that's why it's a tough industry. So from my point of view, I think the four key ways are: one, have deep domain expertise and operating experience in a market that is of interest to them. So Crosscut invests in primarily Southern California technology companies. We look at commerce and mobile and social and publishing. If we were looking to hire an associate or a venture partner, it would be great for someone to have deep operating experience within those domains. The second way is to have extremely broad expertise across a lot of markets. And that often comes from being a consultant that worked on a lot of interesting projects. Maybe it's a multiple entrepreneur background where you've worked in a couple different fields. But being broad is also appealing because then you can be a jack of all trades on behalf of the fund. And then the third way is a huge Rolodex. If you are the ultimate networker that has built relationships at all of the strategic partners that our portfolio companies want to penetrate, you would be extremely valuable to a venture capital firm by being able to open up that Rolodex and make introductions on behalf of the portfolio company. And then the last way and the best way, truthfully, is that you should
probably go out and raise money from that fund with an idea as an entrepreneur and have a success with it and make them gobs of money, and then they're more than likely to bring you in as a partner and make you part of it, because venture is all about taking care of those that took care of you. So 4 primary ways: deep domain expertise, broad set of skills, huge Rolodex, and make them some money, and they'll love you forever.
Yeah, so I just thought that was pretty interesting. From most sources that I found, I kind of found the more general descriptions of what kind of entrepreneurs they look for, as in risk takers, all that type of stuff. But I just really valued Brian's insight on that from his perspective working in a venture capital firm. So then I kind of touched on what industries venture capitalists like to invest in, what type of entrepreneurs and teams they look for. So I wanted to touch on what they actually try to avoid. So venture capital firms will often avoid both the early stages when technologies are uncertain and market needs are unknown, and then also the later stages of an investment when competitive shakeouts are inevitable and growth rates slow dramatically. So they really like that adolescent phase where things are just growing exponentially. And then overall, entrepreneurs will rarely receive backing from a venture capitalist if their businesses are in low growth market segments as well. So this can mean no matter how amazing the entrepreneurs, how charismatic, successful, the venture capitalists will not invest in their company if they don't see high growth potential. So then I also wanted to talk about the reality of good investments. I thought this was super interesting. So actually about 75% of startups completely fail. They go under. So a venture capitalist has to make sure that the projects that do make money and are successful make enough to cover these lost failures. So that being said, venture capitalists plan for this and they're very strategic in how they do this. So in fact, only about 10 to 20% of the companies funded need to be real winners and real successful to achieve the targeted return rate of 25 to 30%. So there's a really interesting study in 2016. It was titled, "How Do Venture Capitalists Make Decisions?" And it conducted a survey consisting of about 900 venture capital professionals at about 700 firms. And it found that the median venture firm closes only about 4 deals per year. And I thought this was super fascinating. They are getting hundreds, if not thousands, of potential offers from entrepreneurs every single year. And so, yeah, you could tell that they're very picky with their investments. And then they're also able to invest in successful enough startups to recoup the losses of the other investments. So if they're only taking on about 4 deals per year, they're assuming 3 of those will fail, and that last one has to make enough money and be successful enough to recoup the losses of the other ones. So you could just tell these venture capitalists are very strategic. They know what they're doing. They know what they're looking for. So yeah, I also found this really interesting. Pretty much how venture capitalists spend their time. I was surprised by a lot of these percentages, and I'll kind of open it up to the class and see what you guys think as well. But most venture capitalists distribute their time among many activities. They have to identify and attract new deals, monitor existing deals, allocate additional capital to the most successful ones, and then they have to help out with the exit options. So this chart shows the percentages of time venture capitalists spend doing each activity. So like I said, I was pretty surprised. For example, I would have thought there would be way much more time spent in the exiting process. For me, that seems like one of the most important processes because that's essentially where they find their profits and where they make their money. So I just kind of wanted to ask you guys, is there anything that you guys find really intriguing or surprising about how they spend their time?
Yeah, I had a comment on that. So in terms of like angel investors actually give a lot of their own time to their own investments. But if a venture capital firm is investing in, a lot of different companies, do they provide the same kind of like like it says in there there's acting as consultants, but like realistically, this is more a question for Rick. Do VC firms give like advice and help to the companies that they've invested in? Like, do they spend a lot of time on that, or not really?
So Dylan, that's a good question. So think about it like this. As we move up the food chain from angel investor all the way to private equity firm, we move from having the angel investor that invests their money and their time, and end up at the private equity investor that just invests their money and very little time. And so it's all dependent upon what is needed, of course, but more often than not, the venture capital firm and venture capital fund will invest little time outside of serving on the board of directors and providing just some advice and input. And usually the most important thing that they do within any of that is they select the CEO, of course, and that's a board of directors function.
Awesome. Thank you for that question, Dylan. Yeah, so I just have a few more slides here that we'll get through. So I wanted to touch on venture capital geographics. I thought this was pretty interesting. So the states California, Massachusetts, and New York have been recognized for pretty much their consistent dominance as the country's venture capital hubs. So these three states accounted for actually 53% of the total deal count and 73% of the total capital invested in 2019. It is important to note that these three companies, they're not only investing within their state, so it's not like that. They do like to invest in other states as well, but this is just where those funds kind of came from in 2019. And then we're also seeing venture capital increase rapidly across the globe, which is super interesting. As far as global startup funds, in 2019, the United States represented 52 of the global total, and this was compared to 67 of the global venture capitalist dollars in 2019. So we're consistently seeing that percentage go down and down as the global venture capitalist firms increase around the world. So yeah, this diagram I had to the right, again, just kind of shows the top states in 2019, the number of funds, and then the number or the amount that they contributed. And then I just wanted to kind of wrap up and talk about the economic impacts of venture capital. So when a company is really successful and has a strong public offering or is acquired, the stock price of the company increases, and this results in great economic success. So in terms of the venture capital firms themselves, they've generated billions of dollars for investors and their institutions and have created millions of jobs over the years. But it doesn't only stop there. For the venture-backed companies, they've contributed even greater economic success. They've scaled, gone public, become household names. I think a few of them I was looking at was Airbnb, Jewel, Robinhood. You have these really like household name companies that are adding a lot of economic success. And at the same time, they've generated a lot of high-skilled jobs and really trillions of dollars for the benefit of the U.S. economy. And then just as a final overview, I just wanted to wrap up the entire venture capital process and demonstrate how it really works in an ongoing circular path. So they start with fundraising from LPs such as pension funds, financial firms, etc. Then they have the investment process where venture capitalists invest in high potential startups through several stages. We talked about seed stage, Series A, Series B. We should expect good company growth from a few successful companies. And then after a few years, the companies will undergo an exit strategy, whether it be an IPO or a buyout. Venture capitalists and their partners will gain their profits, split it up, and then the venture capital firms will turn around and start the process over and reinvest. So that's kind of the whole overview of how venture capital works. And then I have my references, and now we can open it up for questions.
I have a question about the exits. Can you go back on the slide before?
Yeah, for sure. The exit slide?
like, or maybe even like this one, but like, so because you said before too that if the entrepreneur, like if the company is failing, they don't have to pay back the venture capital. But so what if they succeed? So yeah, they have a lot of success and all that stuff. How does it work for the venture capital to have the money back? So is it in a contract at the beginning, or is it just like discussion after with the between entrepreneurs and investors?
If you don't mind me stepping in here for the discussion part, the way that kind of works is when the VC invests their funds, let's say they value $4 million, they give them $1 million, they take 20% of that company. So they have 20% essentially of the shares of that company, now they're preferred or common shares. So when they go on to either an IPO or to a merger, any of the money that goes in that business, they have rights to 20% of that money. So then they can take that and reinvest it.
Oh, okay, so it's a kind of a contract they're making with the entrepreneur at the beginning of when they're investing, right?
Yes.
Okay.
Well, it's more than a contract, Alex. The venture capital investor is going to acquire a certain percentage of the company based upon purchasing a certain number of shares. So that then gives them an undivided interest to the company based upon the percentage ownership. And when there's a transaction in the works, then they receive their benefit by having sold their shares.
I had a quick question, Skylar, off of what you just said.
Yeah.
Is there generally like a rule of thumb or a law that states like when these people are able to liquidate those shares when it goes public? Is there like a time period that they have to wait?
There are some sort of, there's a negotiation that goes on, and there's, I guess, in the contract of their acquisition of certain amounts of shares, especially if they take control of the board, or if they have more than 50%, they have almost all control in when and where that happens. There's definitely a lot of talk on what's best for the company in terms of creating cash flow for the VC. I don't think there's any set in stone guideline for every business, but it is definitely hashed out during the VC process.
They're actually
and they're legally, I don't think there's any requirement on how long shares have to be held. I think a venture capitalist could sell them the next day if they wanted to. I don't think there's any legal rules.
Actually, when you undergo an IPO, the insider shares go through a lockdown period, which is, I think, around 90 days usually, inside of which you can't really liquidate your position.
Well, and remember that it's the minority of these companies that do IPOs. Most of them will have exits either to other investors in the venture space or other investors in the private equity space, or possibly being taken back into a smaller private space by just a very small number of investors. So, but I think part of what you're asking about is when is that expectation created as to how we're going to be able to get our money out of this? And when the venture capital firm raises money from investors, they raise that money with an expectation that we will liquidate this fund in X number of years. More often than not, that's about a 10-year time frame, and 10 to 12 years. So once you get to the point where that clock is kind of winding down, or the company that you've invested in has had its major growth and is now starting to level off, then you'll find the VC firm look for the exit, and that's when the investors are going to receive some of their funds and returns.
Sorry, I have a quick question before everybody keeps going. Can someone go into detail what IPO is?
So that's a good question. And I don't remember which of you right now has IPOs on your concept development. Do you guys recall very quickly?
I have it. So it's Victor.
So Victor, can you give a brief answer to that for us, please?
So yeah, so initial public offering. So it's essentially in really short terms, it's when a company is preparing to go into public markets. So for instance, they're listing their company into NASDAQ. So that means then that when you have an initial public offering, that you're going into other investors, institutions, and trying to sell your shares. And then that's before the transaction is going to happen into the market. And then you're creating also, before that, you're creating a price on the share, and you're trying to sell to as many as possible your shares. And then when the market opens then in for instance on NASDAQ, then they're publicly traded shares of the company. I think that's sort of how to tell it shortly. I don't know, Rick.
Thanks, that was great.
Skylar, where else would you like to take us here?
I think Ashlyn definitely touched on this. Just that VCs tend to invest in certain industries like AI, machine learning, fast-growing tech, and biotechnology. I think it's kind of good to think about now, especially with coronavirus, COVID-19, changing the way that business is operated. If anyone thinks that there'll be a new market that opens up that VCs will be looking at, or if specific markets within a market, so a niche that VCs will definitely start to take more focus on that they hadn't previously.
I had one thing I sort of would like to ask and discuss about is that stuff the little bit when Reed was talking about startups and now Ashlyn with the VCs, that the differences in contracts. So when things start to go wrong, meaning that in venture capital firm when things are starting to go south, what happens in the firm? Does the VC have the right to step in a larger way? Do they have the right to take over the company? Can they kick out the entrepreneur of the company and then start managing the company themselves, or do you have any insight on that?
I might have a little bit of input for you there, Skylar. This is all a function of who controls what. So Victor, if you have sold 70% of your company to a group of venture capital investors, and and each one of them, say, holds 10%, then any one of them can't force a decision, but they can collaboratively do so. You, on the other hand, are nearly powerless if they've collaborated with each other and formed a consortium, if you will. So it's all about who has what kind of control. But more often than not, the board of directors, which is populated by the investors and the founder, the board of directors is going to make those decisions. And yes, if the company is headed in the wrong direction, the board of directors will oftentimes relegate the founder to some subordinate position and bring in another CEO. And very often that CEO will come from one of the VC investor firms.